Hi guys, today I'm going to talk to you about active and passive investing. Two terms you probably heard thrown around in media and in investment conversations, and it's essentially the discussion about two different types or styles of investing. Now, active investment refers to investments managed by a fund manager with a team of researchers that will essentially do stock selection based on their insights into doing evaluations of companies on a quantitative as well as a qualitative basis. Now, what I mean by quantitative and qualitative is that qualitative is the non-numerical basis. Qualitative is like the strength of the management team, research and development strengths of company, new products that could be coming out that might be a potential flow of revenue in the future. Whereas quantitative analysis refers basically to the evaluation of financial metrics, statements, financial ratios, that kind of thing. Now, the reason it talks about active versus passive is a style of investing that has come about where it's essentially computer driven or it's managed by an algorithm. And you get some very smart algorithms that can do a lot of clever things, including evaluate financial statements and do certain kinds of quantitative analysis and make investment decisions based on an algorithm. The main difference and why it's such an important discussion point is that the argument has been made that one is better than the other, and each side has an argument for their case. I don't think that it's really a case of one is better than the other. I think there's a place for both investment styles, but I think they should both be incorporated within an investment understanding where they function best. Now, to draw a comparison, I'd like to draw parallels between a car and a motorcycle. A motorbike is essentially an engine that's got a seat strapped to it with some handlebars. It's a lot cheaper than a car. It's a lot more thrilling. You can weave through traffic. It's very nimble, but there are more risks involved. You have less protections, and also you get less protection from the weather, for example. If it's a rainy day, you're going to have a miserable ride. You pay a lot more for a car, but you get a lot more protection. You get more safety features, and the ride is potentially a lot smoother, but you've got the chance of being stuck in traffic and things moving a little bit slowly sometimes. Both vehicles will get you from A to B, so they do the same function, but your experience is very different. And that's pretty much what active and passive investing is like. With a passive investment, because it's essentially a computer program that decides an index that is to be tracked or a certain set of investment parameters that have to be maintained, it is a lot cheaper, and that's the big thing. It's a lot more affordable, anything from 0.4% up to 0.8%, but very rarely even more than 1% in management fees. Whereas active managers with research teams, they have a lot heavier cost components, and they have to do stock selection. There you're paying anything from 1% right up to 2 or 2.5%, depending on the funds and the cost structures. Now, the reason there's a large debate is that research has shown that over a 5-year period or longer, only 15% of active managers can outperform their benchmark, saying that if you're in a long-term portfolio, a passive strategy or a larger component of a passive strategy might make more sense. But keep in mind that during bear markets or sideways markets, stock picking it becomes more important, and your active manager has a very important role to play. So there is, for shorter term portfolios, I believe, a larger component of active management to take place. Also, in specialist areas, there just isn't a way for specialist fund managers to use a computer to make a decision. And I'm talking about niche funds like certain technology sectors or certain index or industry specific sectors that you want to invest in. Their active management is the best way to go. So I hope that's explained active and passive for you a little bit better, and we'll be happy to show you how we incorporate those into our portfolios. Thank you.